Hey everyone, welcome to the Koo Trading Desk. I'm Maya, and I'm here with Vid. So today the Fed held rates, and I was reading about how stocks reacted, and honestly, I still don't understand the connection. Why do interest rates even matter to a stock price?
Okay, great opening question. So here's the thing, Maya. A stock is just a claim on future profits, right? And when you decide whether to buy that stock or lend money to the bank instead, you're comparing two different future paychecks. The Fed controls one of those paychecks.
Wait, explain that. What do you mean two paychecks?
Picture this. You've got $1,000. You can either buy a piece of Apple hoping it grows and pays you dividends, or you can lock it into a treasury bond that pays you 4.5% guaranteed a year. Right now, that treasury is paying 45%. So the Fed just said rates stay right here. No change. And investors are thinking, do I want stocks or bonds? That's the tug of war.
Oh, so when rates go up, bonds get more attractive, and people sell stocks to buy bonds instead.
Exactly, Maya. You nailed it. And the flip side, when rates drop, bonds get less attractive, and suddenly stocks look way more appealing relative to that safe paycheck. Right now, with the Fed holding at 5 to 75% and signaling no cuts until 2027, there's no relief coming. It's like, okay, we're gonna stay here a while. And that means investors are saying, if I'm not getting relief in rates, I'd better find companies with earnings that are actually growing.
So that's why today Dell's stock jumped like 34%, because earnings are real and the Fed's not cutting.
Bingo, Dell crushed earnings, so the money that's waiting for lower rates to show up just goes, you know what, let's buy the company that's actually delivering profit right now. When rates are stuck high, earnings become the main game. That's your edge as a trader.
Okay, but here's what I don't get. The Fed holding rates the same, that should feel boring, right? So why would the stock market move a lot?
Right, so the surprise is the thing. Let me use another analogy. You and your friend both know there's a thunderstorm coming. The storm shows up. Nobody's shocked. But if the forecast says sunny and then a tornado actually touches down, everyone freaks out. The Fed met expectations, so there was no surprise, no shock. But then you look at earnings Dell beat. Adobe is literally killing its own photo business with its own AI, and the market's like, okay, these are new stories. And we're gonna reprise stocks based on actual business news, not the Fed decision.
So it's the surprise that moves stocks, not the number.
Completely, you got it. The Fed could have cut rates that would have surprised everyone and stocks probably would have jumped. But rates held steady. That was priced in. So the market went okay moving on. What else is happening?
Right, so if the Fed eventually does cut in 2027, what happens then?
Great question. So there are a couple of ways that plays out. Scenario 1, let's say the economy starts slowing down in late 2026, and in early 2027 the Fed cuts because they're worried about a recession. Well, bond yields fall, stocks rally hard, because now you're comparing stock returns to like 3.5% treasury yields instead of 4.5%. Way better deal. Scenario 2, inflation stays low, growth stays fine, and the Fed cuts just because they can. Stocks do okay, but there's no panic buying. Scenario 3, and this is the scary one, the Fed cuts because the market is having a crisis. In that case, stocks might not rally at first because everyone knows the Fed only cuts in emergencies.
Oh man, so the same action, the Fed cutting, could mean totally different things depending on the reason.
Exactly. That's the key insight, Maya. The action is the same, but the narrative around it changes everything. Right now, the Fed's narrative is, we're staying here, we're hawkish, we're not in a rush. That tells you the economy's probably okay, so investors aren't freaking out. VIX is down at 15, which is calm. Oil's at $87. The market's saying, okay, we're not in an emergency. We're just gonna wait for company earnings to justify the stock prices we're paying.
So right now, as a beginner, what should I actually be paying attention to?
Two things. One, watch the next earnings season. If companies keep beating like Dell just did, Stocks will keep going up because rates aren't falling to rescue them, so earnings are the story. 2. Watch the Fed for any hint they are thinking about cutting sooner. If you hear maybe 2026 instead of 2027, rates fall fast and bonds look way worse. Stocks would probably surge.
And what if earnings start missing? Like, what if companies start disappointing?
Then you've got a problem. Because if earnings are the only thing supporting stocks and earnings disappoint, and the Fed's not cutting to save the day, you get a sell-off. That's when people move money to bonds, because at least bonds pay you 4.5% guaranteed. That's why earnings matter so much right now.
Got it. So the bottom line is, the Fed controls the floor, but earnings control the upside.
Yeah, I like that. The Fed basically says, here's how much free money you can get from the bank. Anything above that, you've got to earn through real business growth. Right now, the Fed's saying not much free money. Go earn it.
Cool. Well, I feel way less confused now. Thanks for this.
Just remember, interest rate decisions only move stocks if they surprise the market, and they only matter relative to company earnings. The Fed raising rates isn't bad if companies are growing fast enough to make up for it. The Fed cutting rates isn't good if it's because the economy's melting down. It's all about the context. And always remember, this is educational only, not financial advice. Do your own research before you trade.
Love it. If you want to dig deeper on any of this, come join us in the Discord. We're living there almost every day talking through all this stuff. Thanks for listening, everyone. See you next time.